By October 2025, Florida's housing market no longer looked like the paradise developers had promised. Listings were vanishing. Sellers were yanking homes off the market at record pace. Local news called it a silent strike, while the governor's office scrambled to reassure anxious buyers that everything was under control. 2 years earlier, the state could barely keep up with demand. Moving trucks jammed highways. Open houses looked like amusement park lines, and bidding wars pushed prices to record highs. Now, that dizzy euphoria had flipped into a standoff. New listings were down more than 7% across the summer, withdrawals up roughly 60%. For buyers, the change felt surreal. They had waited for bargains that never came. Prices refused to collapse, hovering just 4% below the 2024 peak. Sellers, once desperate for attention, were suddenly saying, "No thanks." Agents from Miami to Tampa described entire neighborhoods fading from the public MLS like disappearing ink. The governor's Monday briefing tried to sound calm. The fundamentals remained strong, but those fundamentals included shrinking inventory, soaring insurance bills, and frustrated builders halting projects. Beneath the headlines lay something deeper than policy. Homeowners weren't panicking. They were calculating. Many carried pandemic-era mortgages under 4%. Selling would mean giving up that golden ticket for a 6+% loan on the next property, an extra $800 to $1,000 a month. Families looked at the math and quietly chose patience over movement. This wasn't speculation, it was financial self-defense. With the cost of new insurance quotes rivaling mortgages, moving didn't make sense. Economists called it the lock-in effect. Agents called it, "Please don't call me until rates drop." For the first time in years, Florida's problem wasn't too much demand or too many houses. It was refusal. Anyone hoping for a flood of price cuts discovered a wall built of stubbornness and low interest rates. The state that once symbolized relentless growth had hit its pause button. And that pause sends ripples beyond real estate statistics. Construction jobs stall, businesses that depend on mobility slow, and tax revenues tied to transactions flatten. But none of that resonates as powerfully as the image repeating across social media. For sale signs taken down, replaced by silence. A market built on motion had discovered inertia, and no one, not even the governor, could force it to move again. To understand Florida's strange calm, rewind to 2022. During the pandemic migration wave, the state looked unstoppable. More than 314,000 new residents arrived, many from high-tax northern cities. U-Haul ran out of trucks by March. Remote workers chased sunlight and space. Florida offered both. Mortgage rates hovered near 3%, essentially free money. Teachers, nurses, software engineers poured in convinced they were buying a lifetime bargain. Anna Alvarez, a Chicago schoolteacher, still remembers the panic of house hunting then. 20 offers in 3 days, sellers demanding inspection waivers, buyers wiring deposits sight unseen. She and her husband finally secured a 4-bedroom outside Tampa and framed the deed like a trophy. Back then, slowing down seemed impossible. Builders worked double shifts, lenders churned paperwork until midnight. Every day set a new price record. Developers read that frenzy as permanent truth. Subdivisions sprawled from Jacksonville to Naples. Tower cranes turned Miami's skyline into a forest of steel. By 2023, Florida issued so many building permits that materials back orders became routine. The assumption was simple: population growth would save everyone. It always had, right? But economics has a favorite hobby: humbling assumptions. As 2024 rolled into 2025, the buyers thinned out. Mortgage rates doubled, insurance costs exploded, and those same corporate transfers that once fed the boom began to slow. Yet thousands of new homes kept arriving, flooding the market with options. Sellers who bought too late felt the chill first: longer wait times, lower offers, rising anxiety. By the summer of 2025, momentum broke. The headlines that once bragged "fastest growing market in America" turned to "inventory glut looms." What came next no one predicted. Sellers would rather pull listings than drop prices. The manic energy that built Florida's success transformed into a stubborn pause. It's the equal and opposite reaction to the pandemic rush: optimism giving way to defense. When markets rise on euphoria, they rarely decline with grace. They freeze. And Florida, caught between its past boom and uncertain future, now stands as Exhibit A of that freeze. The same wave of newcomers that fueled prosperity became the undertow dragging confidence away. If optimism had an address, it was Florida's construction sites in 2023. Across South Florida alone, more than 16,000 apartment units were in the pipeline, 300 in Miami. Bulldozers cut new streets through former pasture lands. Marketing brochures promised resort living within reach. Builders acted as if population charts were commandments. Statewide permits surged in double digits for 2 straight years. Major players, Lennar, D.R. Horton, Pult, sped timelines, eager to harvest the final months of cheap financing. Smaller outfits followed, borrowing heavily to share the boom. For a while, it worked. Every slab poured was pre-sold. Waiting lists stretched so long that buyers joked about inheriting spots from relatives. But momentum has gravity. By late 2024, the crane still swung even as buyers wavered. Insurance premiums jumped like co-stars demanding bigger salaries. Material costs stayed high. Then mortgage rates crept above 6%, puncturing affordability. What had felt like infinite demand turned out finite. Suddenly, Florida wasn't building for people arriving. It was building for people already satisfied to stay. When those projects hit completion in early 2025, supply ballooned. Blocks of unsold condos stared across Biscayne Bay at each other's empty balconies. Subdivisions outside Orlando unveiled polished model homes only to see weekend traffic trickle to zero. Builders whispered words they hadn't used in years: incentives and price reductions. Carlos Gutierrez, a Central Florida builder, noticed it first on payroll Mondays. Too many men, not enough work. By spring, he mothballed 2 subdivisions, the equipment parked like dinosaurs after extinction. Across the industry, confidence evaporated. Even large developers began pivoting toward rentals. The governor's economic advisors framed the slowdown as market equilibrium. Contractors called it panic with better branding. Whatever the label, the pattern was clear. Oversupply meets hesitation, prices pause, psychology shifts. The cranes that once symbolized ambition began to symbolize risk. Each skyline tells a story of timing. Florida's rising over bays and cul-de-sacs now tells a cautionary one. Build yesterday, sell tomorrow, regret today. The greatest boom since the Great Recession had left behind not rubble, but emptiness, the stillness that follows when everyone decides to wait. By mid-2025, data analysts noticed anomalies. Listings down 2% in May, 4.8% in July, nearly 8% in August. Delistings up 60% year over year. That pattern wasn't noise, it was retreat. Apartment after apartment, townhouse after townhouse quietly disappeared from online platforms. In Miami-Dade, for every 100 new homes posted, roughly 60 were pulled. Tampa's numbers trailed close behind. Agents described a new rhythm: list, linger, vanish. Homeowners called their brokers whispering the same line: we'll try again next year. Many shifted to private pocket listings or temporary rentals. The public inventory shrank even as demand slowed. Miami's condo towers, brimming with glossy brochures, became museums of patience. Market watchers leaned on data from Altos Research and Realtor.com to confirm the trend. Both showed nearly identical drops, month after month. In a state addicted to momentum, stalled movement sounded alarms all the way to Tallahassee. Economists debated whether tightening supply would hold prices steady or freeze the market entirely. Mike Simonson of Altos summarized it with surgical precision. Florida inventory is finally declining after 2 years of growth. Those words smacked investors awake. They expected overflow from the building spree. Instead, they got a sudden vacuum. Buyers who waited for clearance sales found slim pickings. Across neighborhoods, psychology flipped. Sellers with low mortgages no longer feared missing the peak. They feared replacing their payments. Some turned aggressive. If I don't get my number, off the market it goes. The result? Homes lingered longer, yet values refused to fall. A paradox. Plenty built, little for sale. This is where the governor's panic finally made sense. A stagnant market doesn't produce ribbon cuttings. It produces voters asking why nothing moves. And yet, from the homeowner's perspective, the logic is flawless. If waiting costs nothing, why compromise? If this kind of no-spin breakdown helps you see what headlines skip, tap like right now. It tells the algorithm to share this analysis with others tracking the same roller coaster. Next, we uncover the psychology behind this stubborn patience, the 3% golden handcuffs gripping every locked-in Floridian. Meet Ana Alvarez again. Her 2022 mortgage sits at 3%. Selling would double her monthly payment even if she bought the same house at the same price. She's not alone. Nearly 80% of Florida homeowners locked into rates below 4%. For them, moving now feels like burning cash on purpose. This arithmetic shapes everything. A $400 loan at 3% costs roughly $1,700 per month. At 6.3%, around $2,470. That extra $770 isn't a cup of coffee, it's groceries, tuition, life. So people stay put. The mobility that once defined Florida freezes under pure math. Economists can wax poetic about elasticity. Homeowners just read a payment calculator and shake their heads. The lock-in isn't merely financial, it's emotional. That low rate became part comfort, part identity. It's the story told over backyard barbecues. We got in at 3%, you can't beat that. It turns neighbors into stalemates because everyone clings to the same advantage. As rates rose, those homeowners transformed from speculators into sentinels guarding their loans. This I'll wait stance spread faster than any official policy ever could. Suddenly, being inert looked like wisdom. And it is, short-term. But collectively, it suffocates supply. With fewer willing sellers, builders halt, agents lose volume, and young buyers face a distorted landscape where affordability collides with scarcity. By fall 2025, the divide was clear. Motivated sellers, divorces, relocations, estate sales made up barely 20% of listings. Everyone else opted out. Online, the tone changed from urgency to defiance. Posts on homeowner forums read like mantras, "We'll stay put until rates behave." This quiet defiance defines the current era. The same markets that once rewarded speed now reward stillness. The pandemic gifted homeowners cheap money. The aftermath turned that gift into long-term glue. Florida's housing story isn't about bursting bubbles. It's about frozen ones. Next, we'll watch how that freeze ripples outward to the construction crews, landlords, and insurance agents left standing in the cold. For 2 straight years, construction cranes had been Florida's unofficial state bird. Then, in 2025, they began to disappear. Builders who once bragged about non-stop projects were suddenly talking about strategic pauses. Carlos Gutierrez, a Central Florida veteran contractor, tells his crew the simple truth. We built for a demand that's no longer moving. Streets are paved, foundations poured, yet half-finished subdivisions now sit fenced and silent, ghosts of optimism past. It isn't just sentiment. Data shows statewide permit applications plunging by double digits since spring. The Giants, Lennar, DR, Horton slashed new starts in Cape Coral and Miami-Dade. Even mid-size builders scrapped land options when spreadsheets stopped penciling out. The math flipped entirely. Materials remain expensive, labor scarcer, and carrying costs punishing. When homes linger on the market for 50-plus days, holding inventory becomes a liability, not an opportunity. In response, builders turned into landlords. Build-to-rent has become the phrase of survival. Instead of selling at reduced margins, companies rent new homes for steady income until prices recover. Carlos converted 12 of his spec houses into long-term leases within months, his sign changing from "for sale" to "for rent," new construction. It's an elegant band-aid, but not a cure. The ripple effect spans the economy. Hardware suppliers report canceled orders. Framing crews scatter to other states. Small municipalities lose building permit revenue that once padded local budgets. The hyper-productive engine that powered Florida's pandemic boom shifted into idle, its hum replaced with quiet uncertainty. Officials try to rebrand the slowdown as cooling to sustainable pace. Yet at street level, sustainability looks an awful lot like stagnation. The industry knows it. You can only store so many trusses before they start to rot. And while developers hold breath, the clock ticks for the broader market. Each month without new starts means future shortages if demand unexpectedly rebounds. It's a paradox worthy of Florida's glossy sunshine, simultaneous glut and scarcity forming on opposite ends of the same pipeline. For now, builders wait, borrowers cling, and the rhythmic hammering that once echoed from every cul-de-sac has been replaced by the hushed question, when does motion return? When homeowners refused to sell, they found another weapon, rent. Nearly 1 in 5 homes withdrawn from Florida's sales market this summer didn't disappear. It reappeared as a listing on Zillow under the For Rent tab. What began as improvisation has hardened into strategy. With mortgages locked at 3%, many owners realized they could cover costs, and in some cases profit, by leasing their properties while waiting out high rates. Take the Miami waterfront condo priced at $840,000. After 3 months without a nibble, its frustrated owner pulled the sale and relisted at $4,200 per month. Same granite countertops, new headline line, available immediately. 24 hours later, a corporate tenant signed for 1 year. Mortgage covered, insurance paid, and the owner now wears the title Accidental Landlord. Florida's new housing class is born out of hesitation. Statewide, Altos research found that 22% of delisted properties shifted to rental. Those numbers overlap seamlessly across Tampa, St. Petersburg, and Broward. Real estate agents, once specialists in closings, are hastily adding leasing divisions. The consequences form a curious feedback loop. As more owners pivot to rent, supply for buyers shrinks further, propping up home prices. But rental supply expands, softening rents in some neighborhoods. In Tampa's new subdivisions, tenants have choices their would-be buyer colleagues no longer do. Yet renters remain wary. Many sense they're paying the holding cost for someone else's patience. For investors, the shift is polarizing. Some view it as a golden bridge to steady cash flow. Others warn it foreshadows a shadow inventory that could flood the sales market if conditions worsen. Both are right, depending on the timeline. Walking through new communities, you can practically read the mood by signage color. Blue for builders still selling, green for those who've gone rental. The street tells an economic story more clearly than any spreadsheet. Florida has become a laboratory for the modern hybrid market, half homeowner gridlock, half landlord improvisation. It's a system that works only as long as patience outlasts expenses. Should costs spike again, insurance, taxes, or storm repairs, the patience economy could unwind fast. But for now, homeowners hold the upper hand by doing the least risky thing imaginable. Nothing for sale, everything for rent. Ask any homeowner why they hesitate to list their house, and one number keeps surfacing: insurance. Premiums have turned from annual nuisance into fiscal nightmare. In parts of Miami-Dade, quotes for standard single-family coverage top $12,000 a year. Even modest condos pay $8,000 or more. Private insurers have fled the state in droves, spooked by hurricane losses and litigation costs. The remaining carriers raise rates or reduce coverage to survive. For many owners, policies now rival property taxes. Meet Jeanette Morales from Tampa. Her cozy bungalow once cost $3,400 a year to insure. At renewal, the bill nearly doubled to $7,900. Selling crossed her mind until offers arrived thousands short of what she'd need to offset that spike. So she joined the pullback, delisting her home and bracing for uncertainty. "I'm not gifting the house," she told her broker. "I'll wait till the lawmakers fix this mess." Multiply that sentiment by tens of thousands, and you understand why inventory evaporated. State leaders tout reforms aimed at attracting new underwriters, but results crawl. Meanwhile, 75,000 properties have migrated to the state-run Citizens program, a last resort insurer with high deductibles and limited payouts. For coastal owners, one storm can erase both asset and patience. The insurance crunch doesn't merely squeeze budgets, it paralyzes motion. Prospective buyers hesitate because joining the market means swallowing those premiums, while current owners refuse to sell because switching homes would reset coverage even higher. It's an economic catch-22 wrapped in paperwork. Industry analysts call insurance the silent market mover, unseen but decisive. Every headline on affordability hides it between the lines. A 0.5% change in mortgage rates won't undo a 5-figure premium increase. As one analyst quipped, "You can refinance the loan, not the hurricane risk." Until costs stabilize, Florida real estate lives under two skies, one bright and promotional, one storm-clouded with expense. And as long as safer Florida bills stall in committees, homeowners like Jeanette will keep their listings stored away, waiting for legislation as patiently as they once waited for appraisals. Economist Chen Xiao of Redfin summarizes Florida's trajectory with unnerving clarity. "We're at a crossroads. Falling inventory could stabilize prices or collapse them, depending on which shock arrives first. On one path sits quiet resilience. Low supply props up values, giving breathing room to anyone who bought before 2023. Affluent newcomers still trickle in, keeping desirable pockets alive. If rates ease modestly and insurance costs stop exploding, Florida may settle into a slower, steadier rhythm. Then there's Path 2, the domino scenario. A national downturn, surge in unemployment, or destructive hurricane could flip patient owners into forced sellers overnight. Thousands of rentals would re-enter the sales market simultaneously, crushing prices region-wide. Because patience works only while cash flow does, remove income or safety, and resolve evaporates fast. Analysts watch three indicators: job growth, storm season intensity, and legislative progress on insurance. Together, they determine whether this standoff remains peaceful or combusts. Chen's forecast stays lukewarm, modest price pressure upward in early 2026, offset by affordability ceilings. Translation: Florida may hover, neither climbing nor crashing, while the rest of the country nervously takes notes. Behind the spreadsheets are real stakes. Cities rely on transaction taxes. Agents depend on commissions. Construction trades depend on new starts. A freeze preserved on paper means lost incomes in practice. Florida's challenge isn't just economic, it's psychological. Everyone's waiting for the other side to blink first. That collective hesitation might become the state's most defining risk. Markets rarely explode anymore. They erode quietly through inactivity. If optimism doesn't return soon, even stable prices will feel like stagnation. Whether Path 1 or Path 2 wins, the deciding variable might be patience, how long Floridians can endure limbo before fatigue becomes motion. Florida's housing drama has outgrown its borders. From Texas to Arizona, builders whisper the same phrase: "Watch what happens down there," because no other state flipped from oversupply to retreat so quickly. For 2 years, pundits labeled Sunbelt markets overbuilt. Then Florida's sellers vanished, proving that scarcity can arise not from emptiness, but from choice. In Dallas, Phoenix, and Charlotte, agents already notice familiar symptoms: listings pulled, homeowners boasting of pandemic-era rates, would-be movers choosing rentals. Florida became the canary in the Sunbelt coal mine, singing a cautionary tune about what happens when cheap loans freeze mobility nationwide. National analysts now track delisting velocity, like consumers once tracked mortgage rates. It measures willpower more than affordability. The findings point one way: patience isn't regional, it's contagious. If there's a moral, it's this: modern housing markets run on psychology as much as concrete. When confidence retreats, cranes stop, and spreadsheets stop mattering. The remedy won't come from a single governor's press conference. It will come from balance, realistic pricing, functional insurance, and economic policy that reconnects mobility to security. For the rest of America, Florida offers a mirror. The sunshine still glows, but beneath it lies a sobering insight. Supply is no longer dictated purely by demand, it's dictated by courage to move. And lately, staying put has never looked so safe.